CEO of Troilus Gold. We are developing the large generational scale Troilus copper and gold mine in central Quebec. We have recently put out a feasibility that showed top tier production, 22-year mine life, incredible free cash flow profile. And I'm looking forward to talking to you today about it, Matt.
Justin, good to see you. It's been a while, but I think this is a conversation that's been on everyone's lips since it came out. You gave us some nice numbers there, but the number that people are focused on is 14% IRR after tax. They didn't like it. Should they?
I think it really looks at, it depends on how you look at it. The answer is yes, they should. These type of deposits do not give you the standard headline numbers that I would say the faster market wants to see, but they're backed by incredible economics based on assets that are going to get built. And so, yes, 14% after tax IRR didn't really, hit a home run with the retail investor. It wasn't flashy on appreciating gold market. However, if we look at all the other low-grade bulk tonnage deposits that have been built in North America, we fall right in the middle of the fairway for the economics that we're seeing. And these are the most profitable mines in the world. So if we look at Detour, the largest gold mine in Canada, when their feasibility came out, they were at 13% IRR. Malartic was sub 20, Conte 13. These are not giving you flashy numbers because the capital intensity involved in building them up front. But when you look at the free cash flow profile of these, they are incredibly profitable. And that's why these are the mines that get built. And Troilus is absolutely no different. So we are extremely pleased with the results because we know we can finance this, and we are financing this, and we are moving forward. So happy to walk through the metrics with you and what these pieces mean, but size, scale, scope, and free cash flow is what the majors want. And we were using long-term prices. We started looking at spot prices of the day and appreciating commodity prices that we all expect. This thing flies. And so we're very excited to move this forward.
Okay, if I look at this in the way that retail have been looking at, you've got two different types of investors. You've got a lot of institutional investors, and you've got your retail, legacy retail holders as well. Retail goes straight to that 14% number. They're saying it's based on 1950, gold, which is pretty punchy because we've been only recently sort of seeing this this surge in gold price. So if that's sustaining or growing, maybe it's okay. Institutional guys perhaps going to take a slightly longer view of this and be looking towards the cash flow. I'm trying to work out which bits I would need to believe and feel comfortable with, and I guess it's around kind of like you're going to have to be super efficient with low-grade gold, mining of low-grade gold and processing of low-grade gold. You're also going to have to be super efficient with your capex infrastructure costs because you're plus 1.5, 1.6 billion bucks there. So explain to me how you can manage the cost of that capital up front and why you're so certain of getting it.
All very fair points. And so our capital in US dollars is just over $1 billion, right? It's 1.08 billion. So we'll round to $1 billion. US. An amazing takeaway here, and we've talked about it for years, and every time we've talked is, the now is tangible. We can put our finger on it. The impact of the infrastructure that we have at site, as a brownfield site that operated for 14 years and already has produced 2 million ounces of gold and 70,000 tons of copper. So technically proven. And we've always said it's worth 500 million US. Well, the actual number is 470 million US. And that really mitigates the capital intensity exposure that you have. So to replace or to build from scratch our tailings facility, as an example, it's a $370 million item. roads and power add up to another $100 million. So a lot of the capital inflation that we have seen from other mines that have been developing over the last 3 and 4 years, they're not fixed price items. They're not your mills, your fleet. You sign a contract, you get those items in. It's the civil works. It is the moving of dirt. It's the construction of the pads. It's how many, and a lot of that is done for us. We have a fairly big pre-strip, but that's a function of being on a brownfield site. The other thing I would say is, and I don't know if we're at the top of the inflationary pile yet, we are the first feasibility, not a PEA, not a pre-feasibility. This is a feasibility study, fully bankable, to really come out in this size and scale in the last 4 years. And so we did take a very conservative approach when knowing we were going to be compared with Cote and others, which are going to be great mines now that the capex is sunk, in Greenstone, now that the capex is sunk. We had to be bulletproof because we're not really putting this feasibility out for the market. We're putting this feasibility out for strategics and mainly our financiers. And the feedback we're getting when you really look at the free cash flow profile, we can talk about that, is that this deposit can carry a huge amount of leverage. And so it actually gives you a large margin for volatility.
Okay. Let's look at the free cash flow, because I think it might make the conversation we're about to have a lot easier for you. If I can and people can understand the sense of what the free cash flow looks like, because you talk about it, 22-year life of mine, but that's only on 50% of the property at the moment.
I'll talk on an equivalent basis, but
go on.
We're 13 million ounces equivalent indicated and inferred, but 11.2 million ounces that is indicated, so higher degree of confidence. Our initial reserve, not many companies have reserves, is 6.7 million ounces. And so, yes, it's just over half. And that is a function of, we have to put a pin in it. We can't drill forever. We have to put some economics around this and continue to move on. And so a 22-year mine life, it is going to be substantially larger or longer. Average production on an equivalent basis is about 300,000 ounces over the 22 years. That includes a big ramp up and a big tail. Our core years between, call it year 3 and year 8, I think we peak out at 540,000 ounces a year, well over 400 for the majority of that. So free cash flow at sub $2,000 in the 1975 is 150 million US a year. At spot prices, that's average. At spot prices, it's over 200 million US. But when you look at our core years 4 to 8, almost 10, it's upwards of 300 to 400 million US in free cash flow. That is absolutely spectacular. And the NPV, the asset value, the DCF model only really takes into account your first 10 years of cash flow. Everything else is free. So, cumulative cash flow at base prices for us is 2.2 billion US. At spot prices today, is over 3.5 billion US. This is a cash flow machine. So our whole premise, scale, 50,000 tons a day, one of the biggest mines in Canada, production volume, top 5 producer in Canada, and life at 22 years minimum. There are not many assets that are going to deliver this, that are currently well advanced in permitting as well. These are the assets that are getting built. These are the assets that are getting funding right now. And we see that in real time.
So who put this feasibility together? And, have they done other similar low-grade projects before?
For sure. I mean, it was 75 engineers, 2.5 years of work. AGP, Lycopodium, and WSP. AGP did a lot around the detour operation. Lycopodium has done a lot of the Australian low-grade bulk tonnage deposits as well. And so, yeah, no wheel was reinvented here. This was fairly straight off the shelf.
Okay. Good. Nothing overly technical here.
There is zero innovation in this model.
Right. Which sounds tongue in cheek, but it's not. It's actually quite comforting, because it's like no one's having to come up with a new strategy for extracting gold here. It's really boring, earth moving exercise. A question of how efficiently you can,
that's
do
what
that.
Is. You're pushing right?
Yeah. Okay. I'm coming back to on the money side of things. Okay. So the cash flow question you've answered there. Again, with my institutional hat on, I guess you're talking my language in terms of the numbers around this, and the two audiences there, but that perhaps some retail might be interested in understanding is clearly you've got institutional investors and shareholders, and then you've kind of got we know where we're going to go and get this money from and how that breaks down. Can you talk about perhaps that you saw a massive drop off the day this came out? You lost 25, 30%?
Yeah, it was 10 or 11% the first day, and then kind of that again.
Yeah. So pretty brutal, right? So there's either a whole bunch of people very, very disappointed, and or a bunch of people who equally didn't understand what you just said, or the opportunity ahead of you. How did that break down? And is it retail abandoning ship, or are you losing institutional as well?
No, it's all retail. It was exclusively retail. I think we probably did a poor job properly educating and preparing. I'll say the broader market. I do spend a lot more time with our institutions than I have with our retail, and so there was almost no surprises for our retail guys or our institutional shareholders going in. But they also invested in these vehicles and lived real time, not only the inflationary environment of these builds, because they participated in the funding of, cocaine, greenstone, and everything else, but previously with Detour Malartic. So I think we could have done a far better job managing those expectations a little bit better, saying this is what these type of deposits deliver. And I think if we would have done a better job there, it may have been mitigated. But we did have a lot of hot money come into our name as well, especially with the gold run, knowing that we're one of the first feasibilities to come out during that time. So
what's hot money?
Faster retail money that wants to come in, look for a catalyst, and then sell on news, unfortunately, is real. And this one was a little harder than most. But,
right. Okay.
But you know what? We're still well above our last deal price. Our institutional shareholders all stepped in and they bought all of the stock. And we see that continuing. So we're getting great feedback from financiers. Our institutional shareholders who are long-term are very pleased with this de-risking event. And that's what this is, right? A feasibility is a moment in time. And this now gives us the firepower and the information to move to the next step. It's all in the de-risk. Well, we're now financing and permitting, and looking at how do we best generate a return for our shareholders as it is now. And permitting is well advanced. We put in our terms of reference or detailed project description almost 2 years ago now. So we're 2 years into permitting, and with the EIA going in at before the end of the year, which is a major step, we're now looking at permitting or regulatory completion kind of over the next 12 to 18 months.
Okay. The money that you're going to need to build this just got more expensive. So you 2 years into permitting, you got ways to go, and you'll let us know when you get near the end of that process. The cost of the money to build this, I know you answered it earlier, but just this is from a slightly different angle, is with the market cap doing what it's done, with the share price doing what it's done, what do you do to kind of get away from this base that's now been formed down at these levels to make sure that the money that you do raise, the equities side of things, and I guess the debt to a large extent too, is not so expensive for you? You've got some time. What do you do?
Well, first of all, we do have time. We do have time. And we haven't really talked about, Troilus has a bunch of levers available to us that the standard gold producer doesn't have. We are producing, I think life of mine is almost 20 million pounds, but during peak years, it's almost 50 million pounds of copper a year. 75,000 tons of copper concentrate a year, incredibly rich in precious metals, largest concentrate producer in Eastern Canada. The con is incredibly clean and in very high demand. Offtakes, prepays, all of the processors and the traders are actively coming with term sheets to us right now. And I think that is going to provide a source of funding that the majority of gold producers don't have. And we're not sure of the ultimate scale, but it's going to be fairly significant. Silver, we produce almost 600,000 ounces of silver. That's average. It peaks at kind of over 1 million ounces during the peak years. If you take precedent transactions right now, over the last 2 years in the silver space, that stream alone could bring between $80 to $100 million US. So, and it accounts for, let me give you the exact number because I have it here, less than 1.5% revenue. So it's irrelevant to the long-term viability of the project, but it could bring a huge amount of non-dilutive capital up front from that standpoint. We have a major, and I'm talking on a 100% basis now, and then we can talk about other options. We've focused a lot on the Quebec institutions, who are very well known for supporting strategic projects that are important to the province of Quebec, of which we are one. And so that provides the opportunity for, I'm not saying it will be all of it, sovereign type debt, which brings your cost of capital down compared to more predatory type numbers that are out there from the large private equity funds. And then you're going to have a big mezzanine piece. So I think we're going to be able to limit the ultimate dilution a lot, because there's some really not great examples where, to get the mine funded, you kind of have to replace your existing shareholders, and that's not great. And so that work trade is underway. At the same time, and maybe even more aggressively, this asset, and I've said it a few times and I kind of bang it home, scale, scope, and output, free cash flow, is of the size that impacts majors, full stop, right? This isn't a 100,000 ounce producer. This isn't a 200,000 ounce producer. And there's some spectacular examples right now of risk being shared and cost of capital coming down. So, a great one was IAMGOLD and Sumitomo at Côté. Sumitomo came in as a partner, capital was shared, risk was brought down, though obviously there's a lot of risk there, but cost of capital came down a lot. And IAMGOLD, I think last night or the night before, put in $400 million to buy back some of the debt from Sumitomo. We have Osisko has partnered 50-50 with Gold Fields at Windfall. Again, John at Osisko has done an incredible job sharing the asset, bringing in a major, bringing in that capital, lowering their total cost of capital, and eventually when the debt comes in, using their balance sheet and that lower cost of capital. We have the same thing at Greenstone. There's lots of great examples. At Tropicana in Australia, when AngloGold Ashanti came in as well, that's one of the first that we saw, 60-40 there. I think that when you are a $150 million company, having to build $1 billion asset, despite all the advantages we don't have a market that wants to reward that yet. And it takes time. So it might. Bringing in a partner would bring validity to the asset and lower ultimate cost of capital and share dilution or save dilution at the equity level to our shareholder. And when you actually run the math, and that's all this is, it ultimately is incredibly accretive to the existing shareholders.
We've seen a lot of companies blow up their capital structure and their share structure over the past couple of years. We've been kind of working through, increased costs across the board. We've seen study after study, miss the target, or made from one study level, from PEA to PFS to up to feasibility study, 30, 40, 50% misses. And then even when they build it, problems arise. Even when they're in production, problems arise. Everything's great on paper till the rubber hits the road, literally. What's the best solution for you guys? I hear what you're saying about partners, and you've given a few examples where you've got several partners come together. Certainly with these multi-billion-dollar projects, because they're going to be attracted by the free cash flow. They're going to be attracted by the life of mine and the simplicity, I guess, of mining. But you're right. It's a $150 million company. It's less than ideal at the moment to be considering doing that on your own. So what's the out of the examples you gave, what's the most ideal situation for you, given the current market, to get this thing actually built? Not talk about, but actually get it built.
Yeah, and this is a mine to get built, right? Everything we've done from day one was to get this mine built. It was never about, here's some ounces, here's a study, and let's sit there and get taken over. These deposits, very rarely does the company actually get taken over, right? Detour had to build it. Cisco had to build it. Iron Gold had to build it. Equinox built it at Grayson. You build these assets and you take on that risk. So our job is to eliminate that risk. I think we've technically got there. And for us, like I said, the partnership is absolutely the best way to go. Expertise, validation, lower cost of capital, big brother approach, if you will. And it is working. And I know, I actually believe, it's not a flippant comment, it's easier to fund $1 billion right now than it is 109. It truly is, because of what this asset delivers you.
Can I explain that? Because that's a really big thing. And we've seen it with other companies. I've talked to development companies requiring $1 billion, $2 billion type capex or all in costs. And certainly the retail market struggle to understand why that's going to be an easy process. You said it's easier to raise more money than less money. So break that down.
Well, easier is subjective. Nothing's easy. When you start talking to private equity funds and the large financiers in the mining space, the amount of time and due diligence and work that goes in. I mean, they don't come to site and say, "Thank you very much. Here's $1 billion." It is a 4 to 6 month relationship building process where every piece of work that you've completed is being reviewed and scrutinized, potentially upgraded. And, we're going through that, and we have been going through that for months. There are a number of groups who under CA have been working with us as we presented this feasibility study over the last 4 months, as we've upgraded to 50,000 tons a day and everything else. So there's a lot of time and money invested in that, and these decisions aren't made lightly. So, from that standpoint, that amount of time and effort, when we're looking at, Orions and Red Kites and Appians, and there's a few other new entrants into the private equity space, that amount of time, they're writing $1 billion checks. And that amount of effort, $100 million, isn't really worth their time unless they see, the bigger prize in the future. And so, yeah, the size and scale right now, especially when you look at the royalty companies like Franco, Reid, and everybody else, that's the size of checks they want to write. And there aren't many assets out there that, more and more in this inflationary environment, but that can deliver that type of opportunity in our jurisdiction in the time frame where we are. We're not 10 years out here. We are, potentially 2 years out.
Okay, so it's go big or go home kind of approach this in a way. You told us what you need to do to kind of drive that stock price back up, and you told us the optionality available to you with some of these additional levers with the copper, the silver, etc. In terms of streaming potentially. What else do you think the market needs to understand about this story to believe? One, obviously, that the funding will happen. Two, that it's going to get built, and three, that you're going to go about it, the right way.
Yeah, well, we are going to go about it the right way. But when you look at our institutional shareholders, I've got 50% of my holding now, of Troilus's holding, kind of on one hand. And, we have two funds that collectively probably own almost 35% of our company now. So you do go about it the right way, right? There's not, these decisions are made by a broader group now as well for ultimate equity return. I would say that, this is tangible and real. And so we have never varied from our thesis. This deposit had just kept getting bigger and bigger and bigger. The more, the first time we talked to you 4.5 years ago, we were a higher grade underground deposit that we said, hey, there's some open pit potential. We're 350,000 meters of drilling, second largest drill program in Eastern Canada behind the guys at Cisco, who I think hit 2 million. Now you're a 13 million ounce asset that is going to produce for 22 years. And so we've talked about it before. It's really just about checking the boxes and systematic de-risking. This feasibility delivered exactly what we needed it to do to continue the process. It now opens the door for partnership and financing. We've had unbelievable interest over the last year as we've been adding ounces. And everybody's, let's see the feasibility. Let's see what the economics are. You've already spent $3 million on it. Let's see what it looks like. Let's finish it off. And it's going to give a great return. Of course, you can only say so many things with 43-101. It's very prescribed. We couldn't give all of the blue sky. But this isn't a 22-year mine life at 300,000 ounces at all. It is significantly more. And you'll see that in some of our exploration that's coming up shortly.
Okay, Justin, I look forward to hearing more from you when you've got more to say. Okay, speak soon.
Cheers, thanks.